is the increase in migration ultimately does filter through to retailers, and this will perhaps be one of the things that might overcome some of the weak spending from the people who are already here.
Look, absolutely, and to be honest, it's supported retail over the past 6 months. The fact we've had strong population growth already, so the retail figures would be worse, but for that. Now, if we look to next year, we're likely to still see, a strong further rebound in population. Particularly in the next few months, more international students coming back for semester 2 study. That will help. And you're right, Ross. Once we get to the point where interest rates have peaked, and consumers have maybe some knowledge that it's not going to get any worse, then we might see overall confidence start to rise a bit.
But that being the case, you might have a gap or a period where those retailers have to survive. Just talking to some insolvency practitioners over the past couple of days, they're particularly concerned about construction and building. But I would have thought with these sort of numbers, there would have to be some genuine concern about retailers, particularly small and medium-sized retailers, actually surviving, getting through this period if the sales simply dry up.
Look, construction is the canary in the coal mine with interest rates. That's the resi construction is the area that's been affected the most. But retail, and particularly the more discretionary area of retail, is next. And we're already going through a period where sales in real terms are going backwards. Retailers are starting to discount. That's one thing that we did see in the retail data in the last few months. Price growth in retail is starting to come down. So it's that pressure of a tighter environment. People are looking to contract their margins. And look, for some retailers, there's only so long that you can do that. And we will see an increased rate of business failure. It's kind of part and parcel of a very sharp tightening in interest rates and rapid deceleration of the economy.
And the reality we're seeing from some economists is potentially as many as 3 more rate rises from the Reserve Bank before they level it off and feel as though they've done their job on inflation. And that clearly is of concern, particularly those who might have just survived through the COVID lockdowns, now got their heads just above water and suddenly get plunged down back underwater again.
Yeah, look, there may well be more. I mean, the Reserve Bank wants to head off, expectations of inflation. It wants to, remove the psychology that inflation is going to keep it at a high rate. So it's pushing on. I would say there's a fair bit of ammunition already in the system from what they've done that still has to translate through. So it takes a little while for the effect of higher rates to flow through to mortgage payments, particularly those who've been on fixed loans. It then takes a while for people to adjust their behaviour so that people are running down their savings first. So there's still some of that transition to come through just from the rate rises that we've seen so far.
I'll tell you what, David Rumbens, always good to have in the program, and many thanks for your time today.